You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Welcome to the show, Bob.
Yeah, Jim, good to be with you.
You mentioned off-air that credit spreads started to widen on Monday, and that's put pressure on the stock markets.
Yeah, it's interesting. There's a whole school of thought in the investment markets that sort of dwell on the stock market, individual stocks, and corporate management, and what the Fed's going to do. And we've found over the decades that that's a bit of a dead end. What you want to do is be watching the whole picture, credit spreads, which of course is the difference between high-grade investment-grade bonds and low-grade junk. And the other is the yield curve, which is the difference between, in treasuries, between long-dated and short-dated. And the fascinating part of this is that the Federal Reserve System and the Bank of Canada has absolutely little influence on the yield curve and on credit spreads when they're ready to change. That's either at the beginning of a credit expansion or at the end of a credit expansion when it changes to what one can call a credit contraction. So going back to last summer, credit spreads narrowed on schedule, and then in June when they started to widen, that got our attention, and then July we were comparing it to what happened to the spreads in 2008 when led to that severe crash in the markets. And it was following that. You needed to have a couple of breakouts in the chart in July, which we got. So then that anticipated the crisis that ran from when Shanghai made its high in early August right down to the crash that ended, as they called it, on Black Monday, August 24th. And you've had generally relief in the credit spreads since then, and then on the 9th of November, that relief started to turn to widening again, but just sort of quiet, you know. But what we were looking for was a breakout through 225 basis points, and that occurred on Monday, so we sent out a quick memo on it saying, hey, spreads are back on widening, and then it moved quicker because yesterday's post on that was out to 231 basis points. They don't sound like big numbers, Jim, but it's the change that matters and then the speed at which it's changing. And darn me, if this hasn't pushed off a fairly heavy-duty liquidation in the equity markets. So they had been doing well out of that heavy liquidation period in August and in September. And on the Dow Jones, we had a target of, the high side was something like 17,800, and the rally to a couple of weeks ago got 100 points beyond that. So that was a nice target, and it hit it, so to speak, exceeded it, and then we started looking for the change because things got overbought on the stock market side. And also, we were, of course, watching the credit spreads, which began to change, but it wasn't until Monday that it got exciting. And the other one was that the yield curve had turned to flattening. Now, when steepening's on, it's happy for the banks, and when it turns to flattening, it's unhappy for the banks. So banks in the U.S. And also broker-dealers have been doing well, a nice rally there, and they are now starting to take out the 50 and 200-day moving averages. So that side's looking, what should we use the term, poorly. And the broker-dealers are interesting index because that's where all the party has been in, where the guys have been making huge salaries, fees, commissions, and I think that the index has stayed pretty well so that they could have a fairly positive bonus season going into Christmas bonuses, but further deterioration in credit markets and in equity markets, of course, start to turn off the money-making spout that they've got in the broker-dealers.
When are we going to see any definite moves? Because people have said when they're watching the markets right now, you have a down day, then an up day. There isn't anything really happening. Would it be bad news that makes something happen?
Well, the markets have been choppy, but that was at a high, and now it's weakening. And there's a lot of internal things in the markets that are the main driver. You can have, a real rush in the stock market, and some financial journalists will put a label on it. It's due to some policy measure or some earnings or something like that, or an economic number. But basically, the turns in the marketplace are driven internally, and then there's the tendency to put a label on the move after it's happened or as it's happened. So technically, the stock market was ready to decline, and I don't know what label they're going to put on it, because the past 2 days have been pretty heavy, and I don't know whether we're going to get the Santa Claus rally or not. That usually becomes visible middle of the month. The other one you can get here, a nice seasonal play, is that from about the middle of December into the first week of January, there's a statistical tendency for the small caps, like the Russell, RUT, to outperform the big caps, like the S&P. So that one is a kind of a trader's tool to use that one. The sort of short the S&P in the middle of the month and long the RUT, but as I say, that's for traders. I think my own view here is fascinating, that the getting the changes in the spread market and in the curve that are negative. You've had change in interest rates. Let's look at junk stuff rated CCC or worse, which in 2014, June was their best there, and the yield was about 7.5%, and now we're out to 17% on junk. And also we go back to provide some comparison here to 2011, when there was a panic in the euro market and their bonds were being trashed, and with that, of course, lower grade stuff in the U.S. went up in yield, and that high yield in 2011 was 16.25%. And it was all kinds of headlines on it, that this was, oh dear, Here we are now up to 17.25%, noticeably higher than in 2011, and as of, say, yesterday, no headlines on it. So we've had a serious increase in interest rates, and the guys at the Federal Reserve are talking about an infinitesimal increase in rates, and the Bank of Canada is talking about further decline in rates, maybe even going minus, when this is absolutely absurd. I mean, I don't know how these guys can talk about this without recognizing that they're absolute fools, because the reason why, first of all, the theory in central banking is that if the central bank provides credit, that then drives business activity. But 300 years of business history shows that is not the case. So here you've got even further absurdities, because over the last 50 years there has been so much intrusion in the marketplaces with rules and regulations and union intrusions and all kinds of things, just friction in the system that would prevent a natural or constrain a natural business expansion. So then the policymakers looking at, the growth isn't strong enough, therefore we've got to stimulate. So they stimulate, and of course all of their red tape in there is preventing an expansion. But if you push on one side, something pops up elsewhere, and what indeed has been happening is that it's not going into economic growth. It's been going into financial speculation in low-grade bonds until a year and a half ago, and into stocks until fairly recently. It tells you where it isn't going. It hasn't been going into commodities, and it hasn't been going into base metals and precious metals and all that sort of stuff. So here it is, and yet many years ago in business, I met Steve Paulos a number of times when he was at, I think, Metropolitan or Manufacturers Life in Toronto. And I thought at the time he was a pretty good portfolio manager. Then he becomes the governor of the Bank of Canada, and he's talking about minus interest rates. It's just sad to see and totally absurd, because that they're talking about minus interest rates is an admission that their theory of providing low interest rate money and lots of credit is not working. So when do they quit these absurd attempts? I don't know. I think if the financial markets get worse, perhaps somebody's going to say, hey, look at your theories are not working. So anyway, it's fun to watch, and it's also interesting to see when they then get the dose of common sense. I think they'll get it from the public. The public will figure it out before they will and say, hey, you guys are off track. We want to reduce your authority. We want to reduce your intervention in the marketplaces. And that, I think, will happen. Who knows whether, not maybe late next year or the year after, but there will be a reformation in the measuring of, or the acceptance of central banking.
We'll have more with Bob Hoye right after the break.
Unbelievable harmonies, spectacular performance, the ultimate tribute to the Everly Brothers and Simon and Garfunkel. Bird Dog and the Vintage Electric Band, Saturday, January 9th at the Alex Goulden Hall. Buy online and save at ontourtickets.com. See singing impressionist Andre Philippe Gagnon.
And I think to myself,
In Oliver, December 29th. In Kelowna, December 30th. Buy online and save at ontourtickets.com.
Welcome back. We're speaking with Bob Hoye. Bob, what's happening with gold?
Yes, indeed. Now, gold had the big bull market ran for 10 years up to 2011, and the dollar price of gold was going up, and also the real price of gold was going up relative to the producer price index. Became a one-way party, and everybody started doing foolish things. We keep track of it by the silver-gold ratio, and the momentum on the silver-gold ratio got up to 92. That was in April of 2011, and the only time that momentum thing had got up to 92 was in January 1980 at the height of that huge bubble in gold and silver. So in 2011, we pointed this out and said it suggested that the speculation had become dangerous and that a long period of bear market would follow. We also said it may not be as bad as the one that followed 1980. But those of us in the precious metal side as investors or traders know that each bear market you've been in is always the worst in history. But I think there are some evidence that this one really is the worst in history. But it's bottoming. It hasn't really bottomed yet. We wanted to see the gold shares beginning to outperform the price of bullion, and that has been improving slightly. We also wanted to see silver beginning to outperform gold, but as of today, that's not happening because with the financial pressures going on, silver has dropped down quite a bit, 21 cents, and gold's up a little. So it's moving against silver, and this is not just discouraging for silver, it's also a warning on the financial markets. When you have, in past periods, you can have volatility in the silver-gold ratio, and then if you get a day like today where silver's down sharply and gold isn't, that's another warning on the financial markets that things have taken a turn for the worse. So on gold shares, we have bought a little recently on weakness. There's no need to have a full position. We don't see buying the metals because you're just trading it off of, it's a currency play. You should have a little gold as an insurance thing stuffed away in a safety deposit box. But to trade gold and silver, you got to be on a trading desk, and to own gold and silver and think that they're going to be up vastly in price over the next few years, that's not likely. The problem being is that in a post-bubble contraction, which we're in, is that the pattern has been is that the senior currency becomes chronically strong against most other currencies and most commodities for most of the time. So this gets us down to being an investor in the precious metal sector, whereby the real price of gold has to go up some more, and then the profit margins will start to improve for gold miners, and then you look to improvement in earnings and cash flows and that sort of stuff from the sector, and then you will seriously invest in the stocks. But as I say, have a little gold as an insurance item, but don't look at it for making huge amounts of money out of it in relative to whatever currency you're in. Yeah, in Canada, you could own some gold, and with the Canadian dollar going down relative to the U.S., that'll make you some money. But if you're in the U.S. owning it, when the U.S. dollar may be generally firm, not going to make any money, but it's always nice to own a little, especially going into Christmas.
Bob, thanks a lot for chatting with us.
Oh, good to be with you, Jim.
My guest has been Bob Hoye. He's the Chief Investment Strategist for Institutional Advisors, the website institutionaladvisors.com. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net. Our popular YouTube channel is Talk Digital Network. You can forward questions or comments for the show to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at talkdigitalnetwork.com. HowStreet.com Radio is a production of How Street Media Incorporated.